Hey, welcome to week 7 of 50, season 2. Today concludes our four-part series examining life insurance companies, and it's perhaps the most exciting yet. Over the past 3 weeks, we've established a solid baseline with the big three, and now we're venturing beyond those industry giants to uncover what I call the hot deals, exceptional product offerings that might be flying under the radar. Idea number one, hot idea number one, term rankings. Let's talk about convertibility. It's the hidden value driver in term insurance. Insurance companies price these products assuming low conversion rates or cancellations at the end of the term period. But here's what makes this fascinating. When health issues arise, policies gain significant market value. An emerging trend perfectly illustrates this. Unhealthy individuals donating their term policies to charities who then convert them to permanent plans, creating an investment vehicle for the charity's mission. Our ranking system weights contract language at 50% for good reason. Take Desjardins. Their contract explicitly states the premium for new coverage is calculated based on the then current rates. Combined with convertibility to age 70 and their joint last to die option, these clear terms earn them top ranking. The remaining criteria balance extra features, price, customer first practices, reflecting our focus on long-term value. Wawanesa has revolutionized the 20-year term market with their guaranteed non-par 20 pay product. After 20 years, clients have 3 guaranteed options. They get fully paid up coverage for life. They receive all premiums back in cash. They can choose any combination of the two. This flexibility is unprecedented. No other carrier offers anything similar. Let's examine a real case. Female 42 non-smoker, 100,000 of coverage. Traditional term, $150 annually. It expires after 20 or 40 years. It's worthless. Wawanesa, for their non-par 20 pay, charges $1,778 annually, but they're guaranteeing $39,300 of cash value. Plus, it's participating, offering potential additional benefits. The flexibility is remarkable. Take full cash, keep coverage, or mix and match with, let's say, 29,000 of cash and 25,000 of insurance coverage paid up. Today, we're examining what might be the most significant innovation in permanent life insurance design. The UL flat face with par-like fund option. This structure has emerged as the lowest risk-adjusted permanent insurance product. I say it's the best deal for permanent insurance. In our week 46 analysis, we demonstrated how this saved a 35-year-old female $100,000 compared to traditional face plus fund design for the same product. Looking at Life Guide quotes with the par-like fund option at 3%, we see remarkable consistency. For male 55, non-smoker, $1 million coverage. Canada Life is 20,000. Manulife's 21,000. Sun Life's a little over 21,000. This clustering suggests a sweet spot in product design that works for both insurer and consumer. Next up, optimal IFA. Manulife's approach to participating whole life insurance, specifically for immediate financing arrangements, stands out through 3 key innovations. Lifetime deposit option at issue, enhanced early cash values, strategic use of term riders. Each feature addresses specific IFA challenges. For a 45-year-old male with 100,000 annual deposit, traditional structure provides 69,000 first-year cash value. With the term rider structure, we're getting 84,000 first year. That's 22% higher. 834,000 future deposit option, which is 27% higher than what you get through the traditional approach. Plus, these additional deposits require no underwriting. These are the features I think are spectacular. The MTAR space by adding the term rider, the additional deposit options. And for IFA, having access to your cash value without tax if you become disabled is a secret way of potentially exiting if it's not going your way. And finally, the fifth idea, corporate surplus concept, accessing corporate surplus. This is the hidden gem of joint last to die. Let's examine Iveri's joint last to die paid to first death feature. This creates unique tax efficiency through tax-free corporate access to cash value. On the first death, when no more premiums are due, you can pull all the cash out tax-free into your corporation. Part of it eligible for capital dividend account credits, the timing flexibility that works in both early and late death scenarios. If you die early and premiums cease, you've won. If you live later and you die later when the first death occurs, the CDA portion will be much higher. Current pricing runs about 20% below market. Look at this. This is Iveri. However, when we see such attractive pricing, professional responsibility demands deeper investigation. Policy contract availability has been limited to me. I've asked for it. If I get it, I'll read it. Product information isn't readily accessible. Distribution strategy focuses on specific channels for Iveri, like the multi-level marketing of WFG, the World Financial Group. The math may work perfectly, but we need comprehensive contract review before proceeding. So in summary, today's exploration shows how innovation often comes from unexpected sources. We've seen Desjardins' contract clarity. It's focused on Wawanesa's guaranteed values. And there's Manulife's IFA optimization approach and optimal IFA through Manulife and Iveri's corporate solutions. Each demonstrates that success requires balancing mathematical excellence with contractual certainty. And with that, I thank you for coming by this week. Let's get ready to discuss in our session. And again, encourage your ideas because we all learn better if we're learning together. Thank you for joining us. Really do appreciate it. Hope to see you here next week.